Hi, this is Candice Paine for Biznews, and I'm sitting with Olga Constantatos, who is Head of Credit Process at Futuregrowth Asset Management. And today we are speaking about the new reincarnation of African Bank Limited. As many of you will remember, the unsecured lender collapsed almost 2 years ago after needing 8.5 billion to survive. At that time, the South African Reserve Bank stepped in and split the bank between the good bank and the bad book. The shareholders lost everything, and the bondholders are able to recoup some of their investments. Olga, can you tell us what the new African Bank looks like?
Sure. So as you said, the performing book was transferred into the new African Bank, and the bad assets were left behind in the old African Bank. There are new shareholders in African Bank. The SARB is now a 50% shareholder. The PIC, on behalf of government, the Government Employees Pension Fund, is a 25% shareholder. And the big six banks are, so it includes Investec and Capitec and the big four, are the remaining 25% shareholders. And what happened was the debt instruments in Old African Bank were effectively swapped for new instruments in the new African Bank. The Old African Bank will remain under curatorship, and the book will be realised and wound up over time. And ABLE itself, which is the holding company of African Bank, is in business rescue, and that's where shareholders effectively, the listed company, they've been wiped out, and there's no expected recovery for them.
Okay, so we have a new African Bank with the old existing investors. What does that mean for pension funds that may have been holding African Bank debt or money market instruments at the time of the curatorship?
Okay, so to explain, there were three types of debt in African Bank. There was senior claims, subordinated claims, and the offshore debt. Those three have been transferred into similar claims, so senior, subordinated, and offshore. If you had a senior claim in the old African Bank, you now have a senior claim in the new African Bank, similarly with offshore, etc. And I'll talk to the senior bondholders mainly, because that's really where our exposure and our experience lies. What happened for the senior bondholders is for every 100 Rand that you as an investor may have had invested in African Bank senior notes, that 100 Rand was effectively swapped into 80 Rand of a new instrument in the new African Bank. You were given 10 Rand cash back, and you effectively took a 10 Rand write-off. Okay. So there's a new instrument sitting in the new African Bank. Subordinated shareholders took a much bigger loss. So senior, as I said, took a 10% loss. Subordinated took nearly over 60% loss. What's happened in the new bank now is that the new instruments are earning you a rate similar to what your old instrument was earning you, which, given the change in economic circumstances, given the fact that it's a new bank, that there isn't really a track record, that they are still servicing a sector of the market that is feeling strain, in terms of the economy and employment, and interest rates have gone up. So all those factors for us point to an inclination that the new notes should have perhaps been issued at a higher rate. We should have been rewarded more for that risk.
What about the new bank's intentions to break into new markets through transactional banking, selling of insurance products, etc.?
Sure. So that's one of their risk mitigation techniques. One of the problems with the old African Bank is that they really only did one thing, and that was unsecured lending. And so in the genesis of the new African Bank, what the management team has decided is to branch out, diversify their income stream, and in that way try and reduce the risk of African Bank.
And what has happened to the new debt? Has it traded at all?
No. So the offshore bonds have traded. There's been a little bit of trade in the offshore bonds, but so far in the local senior and subordinated bonds, there's been no trade.
So out of this, there's definitely been lessons for retail investors. What would you say the most important points are that investors should take away from this bank failure?
So I think it's important that investors know that banks can and do fail. They are not risk-free investments, and when they do fail, investors will suffer losses. And as we saw with African Bank, senior note holders suffered a 10% loss, and subordinated bondholders suffered an even greater loss. And as a retail investor, you might think that doesn't necessarily affect you, but it does. If you had money invested in a money market fund, and if that money market fund had invested in African Bank notes, you would have experienced the loss. Depending on how diversified that fund was, you would have experienced that 10% capital write-off in the senior notes and even more in the subordinated notes. So depending on how diversified the fund is would depend on the magnitude of your loss, but you can and do suffer losses. And as a retail investor, it's important to remember two things. One is that the funds that you invest in, make sure that they are well diversified. And secondly, you need to make sure that you are being adequately rewarded for the risk you are taking on. So to the extent that banks are now, well, not now, they have always had risk, but I think people are now more awake to the fact that they have risk, that you are now compensated in the interest rate that you receive for the risk that you're taking on.
And in terms of the premium that you would have received on the yield from Able at the time, what would the responsibility have been around the asset managers that actually invested in Able to the retail investor? And was that adequately compensating you for the risk that eventually turned out to be in that investment?
So I can't talk for other asset managers, but I know for us what we identified quite early on, some 2 years before Able went into, or African Bank went into curatorship, was that the risk profile of the bank was increasing. And so one of the strategies that we took was to reduce our exposure quite significantly. It went down from 4 billion in November 2012 to just on 1 billion at the time of curatorship, so we significantly reduced it. And the second strategy we employed was also for the exposures that we were getting and that were new, we were demanding a higher premium for them to compensate for the increased risk profile of the bank. And that increased risk profile was informed by our analysis of the bank itself. We saw them making much bigger loans. We saw them making loans of a much longer term. We saw their book growing at a very rapid rate. We saw their provisioning policy, which wasn't as conservative as some of their peer groups. As an example, Capitec started provisioning against their book at the first missed payment, whereas African Bank was waiting for 4 missed payments before they were making provisions. So all those things for us were pointing to an increased risk profile, which we then required an increased premium. But to the extent we'd locked in rates for an instrument 2 or 3 years previously, we were obviously locked into that. But certainly for new investments, we were demanding a higher premium.
And in light of the new African Bank with the new management team and the new strategy, if Futuregrowth weren't already investors in the debt, would you be buying into it now?
I think the question would come down to what rate we would be getting to invest at the moment. I think that with the negotiated compromise that resulted in the new bank and the new instruments transferring over, the rate at which the new instruments are earning interest for investors, we don't believe is adequate. And so depending on what new instruments come to market and get issued, we would have to do an analysis around the risk and reward metrics to make sure that we were being adequately compensated. I think that the track record, or the lack of track record, I suppose, of management would weigh against them, as would the economic environment, as would the competition that they would be facing up in going into these new markets like transactional banking. There are already established players there. So those would weigh against them. But then on the plus side, they also have a lot of capital. They have a lot of support from some very big entities like the SARB and the PIC and the big 6 banks, who are all incentivized to make this work. Their exit as shareholders is reliant on them being able to relist this entity in a few years' time, and obviously they can only do that to the extent it's successful.
Olga Constantatos, Head of Credit Process at Futuregrowth Asset Management, thanks for your time today.